Good morning, ladies and gentlemen. My name is Siboniso Nxumalo. I'm the head of Old Mutual Equities, and I'm responsible, me and the team and I, for managing the longest running unit trust in the country. This particular unit trust fund, the Old Mutual Investors Fund, has got a lot of history. It's got 54 years of history. Now, previous presentation was by Hal George. He painted a picture of the future, what could happen in the world, and talked about the different changes in the world that are actually occurring. But actually, I want to pause us. I want to take us back. I want us to sit down and just, what lessons could we have learned as Old Mutual from running the longest running unit trust fund? The most primary lesson, though, is about long-term wealth creation, which is what we're here about. We're here to talk about long-term wealth creation. It's a noisy world. It's a scary world. Why does investing require a long-term investment outlook? Because markets, economies, and funds are cyclical. We're going to talk about this. And every one of them goes through different cycles. And there's a propensity within our human nature that when things are in a bad part of a cycle, we want to panic, we want to run away. But I'm going to show you why this is probably not a fruitful strategy. So we're going to talk about that. And while we're talking about history, let's go forward. Let's start with a quote. History never looks like history when you're living through it. It always looks confusing and messy. And it always looks uncomfortable. We're living through history. How often do you hear the word unprecedented used to describe today? Very historic. Years from now, people will study this and say, wow, that was a moment, that was history. Things changed. We're investors. We look forward. And so therefore, we know we are living in historic times. But we also know and understand that for us, even for clients, it looks confusing and messy, and it always looks uncomfortable. So back in 1966, if you looked at the news of the day, the news cycle of the day, what was going on in 1966? Well, Chairman Mao was at the helm of the Chinese Communist Party. Nelson Mandela was 2 years into his imprisonment at Robben Island. South Africa was at war with itself. This is back in 1960. Che Guevara was stirring up a revolution back in Latin America. America was at war with communism. America was at war with Vietnam. And there's a Cold War with Russia. We're going to talk about these events. 2 years had passed in Malcolm X's death and the civil rights movement in America. It's amazing how history sometimes starts rhyming. You go back and you're like, oh, wait, these things have occurred. That's what we're going to spend time on. But someone in their wisdom thought it would be a good idea to launch South Africa's very first Old Mutual Unit Trust Fund. Today, that fund is the longest running unit trust fund in the country with a 54-year-old track record. That fund is Old Mutual Investors Fund. We're going to talk about what have we learned in these 54 years of this particular fund. The first thing, which is clear, long-term wealth creation is littered with crises. But before we talk about the crises, let's just look at this particular graph. First of all, at the bottom, you can see the years from 1966 to 2019, that at the end of the day, the graph is going up, which means clients' wealth is growing, that long-term wealth creation. What is interesting, I want to point out first up, is that the last data point includes the coronavirus crash that we've had in the market. You see how insignificant that actually looks in the bigger scheme of things? And it includes all sorts of crises in the history that we're going to spend time on. And so at the top there, we've got different periods, the 70s, the 80s, the 90s, and the 2000s, and their various crises, and what the drawdowns or the corrections from peak to trough that this particular fund has endured. Minus 31, minus 38, minus 39, minus 36, and minus 20. We're going to talk about these are scary times when they happen. And if you look at the detail, there's a lot of noise. When you look at history, there are lots of crises that this fund has endured. But the one thing you must walk away with is that despite all of those crises, the same fund, 54 years, the line is trended up. Value has been created, wealth has been created for clients. So let us start. Go back to the 70s. 70s were an interesting time in the world. And as I start going through each and every one of these periods, you're going to see some similarities. You're going to see some trends, and history is going to start rhyming to you. First thing, in about 1971, America then pulled out of what was called the Bretton Woods Accord. What was this Bretton Woods Accord? It was where the US dollar was pegged to gold. And with America pulling out of this Bretton Woods Accord, all the other industrialized nations, United Kingdom, Canada, also did the same. But what had happened then, that precipitated the decoupling of the dollar from gold as a reserve. Then the dollar started depreciating. In the dollar depreciating from 1971 onwards, that meant that the oil-producing Arab nations in the Middle East, their income, because oil was priced in dollars, started actually also winding down. At the same time, there was the Arab-Israeli war, the early 70s, chaos in the world. And then in 1973, this oil crisis that we talked about, this was a big issue in the world at that time. Why? Because there was an oil embargo. So the Arab or oil-producing nations decided that they were going to embargo. They were not going to supply oil to the Western nations because of their support to this Arab-Israeli war. So what happened? Oil at that time went from $3 to $12 in a very quick space of time. There were queues, there were lines out there. And so therefore, we start looking at this and saying, well, stores ran out of gas in America. And you can see, but in South Africa, there were also issues back in the 70s. Student uprising, it was gaining momentum, and so on. But also in the middle of it, there were political scandals in America. In that Watergate scandal with President Nixon, that was there. Vietnam War was proving exceptionally unpopular, and obviously this oil pressure, and imagine what inflation was doing then, that was causing issues. But South African economy, the South African index at that time was dominated by gold, so that was bailed out because you can see in that little chart that we've got there that oil and gold actually basically tracked each other. So by that sense, South Africa actually did very well back at that time. But South Africa was still apartheid South Africa. And at that time, the movement, especially internationally, and this was a particular picture in London, that movement of boycotting South Africa was starting to take off internationally. And so South Africa was a different place. The fund underperformed. Okay, if we go to the 80s, you can see there's talk about Rubicon speech and there's a state of emergency being declared in South Africa. That's an insane part of time. But you can also see that the chart about the 80s actually, hey, the line still continued growing up despite the chaos. If we look at what happened then, the 80s, there was, at the end of the decade, there was Black Monday, where there was a massive collapse in the Dow and obviously in all other markets globally. But also now the movement on apartheid South Africa, that was actually growing even more. There were sanctions in America, there were political scandals. Seems like there's always political scandals. But South Africa's debt, external debt crisis, actually that was going to take force. So South Africa's balance sheet was weakening. Why? Because there were sanctions in South Africa. And all these industrialized nations and developed nations were sanctioning South Africa. So the South African economy was on its knees. Again, fund underperformed. As we start speeding up in the 90s, this was a fascinating year. South Africa got into democracy in 1994. But actually, South Africans were voting. But as we started getting closer to after 94, 97, 98, there was this thing called an Asian crisis. The fast-growing Asian countries, Indonesia, Malaysia, Thailand, etc., suffered a debt and currency crisis and forced all emerging markets to come down. Dr. Chris Stals, who was the director of the Reserve Bank, raised interest rates at an unprecedented level. And I don't know, some of you can probably remember that interest rates went up all the way up to 25%. It was a crisis. It was a disaster. And then there's this big hedge fund that failed in America called long-term capital management. It was tough times. These were really, really tough times. And at the end of that, in came the dot-com crash to end that decade and begin the following decade. But actually something happened there too. The rand collapsed. And there you can see an article from The Economy talking about how the rand collapsed again. The rand is always collapsing. Now, we start getting into the 2000s. Now, this is our memory here. The 2000s started off actually in a tough way because we had the Twin Towers collapsing. And then we had a whole string of accounting scandals. Most of them based in America, but actually LeisureNet was a South African one. Sambo, the 7th largest bank in South Africa, I think that collapsed. The rand collapsed. I still remember South African companies looking and saying, well, we've got to take our money offshore. We've got to go offshore. This is a disaster. Country's not going to come back from this. Rand went from 6 to 12 in very quick succession. 2008 comes in. Lehman causes a crash in global markets, great financial crisis. And yet, in that same time, China came to the fore and led what was called a global super cycle, commodity super cycle. South Africa benefited from that. Now, what I want you to notice, yes, the fund underperformed, even at that time. But actually, if you look at it, despite how this decade was started, this was one of the finest decades to invest in South Africa, for South African investors. News, terrible. Currency, terrible. Stock exchange, terrible. But goodness me, were the investment returns healthy? So, I've added a new line, and you can see time to recovery. Yeah, so, yes, funds do underperform when things are bad, when the noise is bad, the politics are bad. But actually, you can see, back in the 70s, from peak to trough to recovery, took 34 months. It's a while. But each subsequent one, then it took 13 months in the 80s, 19 months in the 90s, and then 2000 took 14 months. So yes, Are times bad? Yes. But does it end and do things recover? Yes. And so therefore, all I'm saying, hey, what does long-term investing teach us? If you stay in the long term and you are patient, hey, things come back. We don't see them when we're living them, but things come back. But let's go further. But if you look at it, over the long term, this particular fund, the longest running unit fund, has compounded your returns if you just stayed invested over the 54 years, 15.6% per annum. It's a very good return. All you had to do was ignore all of that noise and those crises and just stay invested. But let's talk about investor behavior, because then this is what generally happens in the market. Now, investors always want to buy at the top and always want to sell at the bottom. It's called a behavior gap. And the behavior gap has actually an actual result in that what the investment returns the market and funds give you is actually generally different from an investor return, because investors behave in a way that conspires against their own good. And so now, if we unfold this crisis a little bit more, this is, again, a long-term chart, but this splits the three key sectors in the JSE, which is industrials, financials, and resources. And it shows their cyclicality. This is them relative to each other. What I want to illustrate here is that in crises, create buying opportunities which are essential for long-term wealth creation. So if we just look at industrials and resources on the JSE, you can see that each of them have their different cycles. And actually in this particular chart, you can see that, hey, some of these ones are actually paradoxical or counter each other or inversely related. But now, remember what I said. So if you go back to the 70s, you can see industrials in South Africa, in the oil crisis, they crashed. Resources went up. Why? Because remember I said gold outperformed. So not only is the market cyclical, but within the market, there's still opportunities to create wealth. And you can see that each time you probably had applied your money at the low point on the blue line, which is industrials, in each crisis, generally you had a positive return. Now, on the other side, in terms of resources, but resources themselves had the same issues in that resources themselves have moments where they get into cycles. And the most recent one for resources was 2015. The balance sheets of resources companies were terrible in 2015. But actually, at that time, that was a turning point for one of the biggest and the healthiest returns we've had in our markets. And so, things were bad. The noise was bad. And each time there's a crisis, the noise is bad. But that same noise has produced healthy returns going forward, because bad doesn't last forever. Now, let's talk about opportunities in financials. Start looking forward. Now we look at financials, the same chart. So financials relative to the other sectors, the JSE, All-Share, you can see that each time financials have gone through several crises. Now, South African companies at this present moment, it's a tough economy, there's COVID, there's all that's going on. And we can see, hey, wait a minute, we're back at the same levels relative to the All-Share index that we last saw in the 70s. My question is, yes, we understand there's COVID, we understand there's a crisis, but is South Africa actually worse off than it ever was in history? I've taken you through the history. The noise is always there. There's always a crisis. The rand dares tumbles. People always give up. But we never know the turning points. So to us, we're saying, hey, each time you applied your money at these particular points where there was a crisis, because financials are really sensitive to crises, you actually made money out of that. And so, the last time, we are very positive on South African banks. We think South African banks are actually looking very attractive at the moment. The last time South African banks offered this much value, actually, P.W. Botha had just given the Rubicon speech. And Mandela's release was still, 3 or 4 years away. And we can see there's a chart after that that shows the price to book value, price to asset value for South African banks. So therefore, yes. So should South African banks probably trade at low valuations? Yeah, somewhat, yes. This is a crisis, there will be bad debts. But actually, should it trade at the same value that it traded in the 80s? South Africa had debt issues in the 80s. It was a country under sanction. It was not the country that it is now, but also there's something that has changed in banks that we aren't giving them credit for. Because the valuations are back to the 80s, but actually something has changed. And when we look at banks relative to 2008, one thing that happened in 2008 is that all the regulators in the world conspired to say, well, actually, we can't repeat that cycle. Now, the natural thing from an investor perspective is to say, well, that hurt me before, so it's going to be the same thing that hurts me. But actually, it's different from an investing perspective, because banks globally get tested annually because they're systemically important financial institutions. So every year, they've got to prove they can actually absorb certain amount of losses. And what we've seen from South African banks that they've got more capital than 2008. They've got less leverage, which means their balance sheets are less vulnerable. They've got less gearing or less debt. But their returns are higher. These are much more profitable entities. We think South African banks are unlikely to get a capital raise. And so therefore, we look forward and we say, hey, there are investment returns to be made here. It's a crisis, and we think the market is underestimating how great these businesses are, how resilient they can be, and actually the fact that we can make money out of this. But it's a crisis that has presented this opportunity. And we're looking forward to saying, there's an opportunity to make money here. But history suggests that investors should avoid the short-term noise. Because you can see, over the long term, it's irrelevant, whatever the noise of the day is. Now, all funds, investment funds are cyclical. And so all funds go through cycles. You have good performance, poor performance, good performance, poor performance. It's the nature of life. Clients hate this, but it's the nature of investing. Now, this is another example. So we've just taken funds in South Africa. We looked at funds on a 5-year ranking up to June 2014. Which one was number 1, 2, and 3? What happened by June 2019? Actually, they'd gone cyclical. So the guys who were amazing in 2014, actually, by the time we got to 2019, they were not as amazing. Why? Because actually, investment funds are cyclical themselves. Now, investor behavior, though, actually can work against your own good. Because when times are good, investors tend to hire the manager, and when times are bad, investors then tend to fire the manager. And this is why there is that behavioral gap. And Vanguard put a number to it and said, well, this is why you must buy and hold investment funds. Because buy and hold approach outperforms by 2% compounded on an annual basis. And that is a lot of money for a long period of time. And so what are we saying to clients? The noise is always going to be there. There are always crises. This time is different in its own nuances, but yet it is similar. There are currencies under pressure. There's global politics. Yes, there's racial tension. There's COVID. There's uncertainty. The future's unknown, and the future's unknowable. But one thing that we have seen by going through each and every crisis is that wealth creation still happens over the long term. And all these blips that scare us when you look at your fund statement, actually they're irrelevant in the longer scheme of things. Because wealth creation happens. Humans innovate and companies adopt. And as companies adopt, their profitability gets stronger. The weaker fall out and the stronger get stronger. And so, the perfect relationship, in bringing it into today's terms, about investing, it's about a long-term commitment. It's like a marriage. You stay in it, you're committed. Whereas today's generation, there's this Tinder, you swipe right, you swipe left, whichever's the flavor of the day. Investing shouldn't be conducted like that. And as we come to a close, go back to the first slide. Long-term wealth creation. Why do we need a long-term investment horizon? Because markets, economies, and funds are cyclical. I've taken you through that. I've shown you that. But those very same cycles that scare us present an amazing opportunity for generating long-term wealth, because you get to buy assets at a very low price and at an attractive price. And actually, you've just got to have the stomach to hold on to it. The Old Mutual Union Investors Fund has shown you that, yes, it has grown over the long time and compounded clients' wealth. But you had to weather all those small blips. And even today, we sit here with COVID, we look at an uncertain world and a changing world. And say, well, we'll look back 5, 10 years from now and say, oh, well, that was just a crisis. And so, in closing, the same slide, but with a quote. And I say, history provides a crucial insight regarding market crises. They are inevitable, they are painful, and ultimately surmountable. Ladies and gentlemen, stay invested, stay married, stay committed. Over the long term, as fearful as moments like today's markets are, they actually are largely irrelevant to your long-term wealth creation strategy. So my name is Siboniso Nxumalo, and thank you for giving me your time, and hopefully you will continue to partner with us in growing your long-term wealth through all the various crises that have been and throughout the various crises that are to be that we don't even know yet. Stay invested. Thank you.